Without question, moving average strategies are among the most popular ways to trade. But these strategies do have some problems, namely getting chopped up in flat markets. Now that's where the triple moving average crossover strategy comes in. It's going to keep you out of chop. How? It combines the power of three moving averages to make sure you can spot a trending market and clearly define your entry and exit. Now this video is going to show you how to trade this powerful strategy. All right, let's get to it. The first step in trading the triple moving average crossover is understanding how to interpret crossovers. It's very simple. When price is above all the moving averages, it signals an uptrend is present and there's bullish momentum in the market. On the other hand, when price is below all the moving averages, it indicates a downtrend and bearish momentum is present in the market. Now you'll notice on our chart here, we do use 3 EMAs for our triple MA strategy. Each one of them, the periodicities are different. The medium MA is used to judge trend strength and in trade management. We're going to cover that a little bit later in the video, but there's truly a triple MA for everybody. A 5-8-13 takes you right into intraday scalping on real short time frames, all the way down to a 50, 100, 200 is a good for your swing trading and longer term investment approaches. There's a triple MA for you. You just got to figure out which one you want to use. All right, let's go through the basic concepts of trading the conventional 3 moving average strategy. Now, there's several ways to trade the 3MA. We're going to save those for later videos. This one, we're going to teach you how to trade the 3 moving average strategy on a conventional basis. Okay, we're going to show you a buy and a sell. First, the buy. You'll notice that we're going to use the 9/21.55 EMA strategy here. What we're looking to do is get with the bullish price action. Now, how do we know it's bullish? Price is above all 3 moving averages. Now, how do we enter the market? We're looking for our short-term EMA, our shortest one. In this case, it's going to be our 9 EMA. As soon as that crosses over our medium EMA or our middle EMA, in this case, the 21, that's a signal to buy. It's as simple as that. Now, you may be asking, why do we need the 55 EMA? What's the point? The 55 is our anchor EMA. That ensures that we are in a bullish trend, and that is designed to keep us out of choppy price action and fake out trades. Simple as that. All right, let's take a look at a sell. The bearish market of the sell, first and foremost, price is beneath all 3 moving averages. Okay, we're looking for our trigger EMA, our 9 EMA. It's right there. It crosses over under the 21. We sell it. Just simple as that. There's our 55. There's our anchor EMA, ensuring that we're staying in that bearish trend. You'll notice pretty good trade there to the short. So very, very simple to execute this. We're looking for our short-term EMA to cross our medium EMA. When it crosses over in a bullish market, we buy. And then here on a bearish market, when the 9 crosses the 21 or our short-term crosses our medium-term EMA, bang, we sell. The whole idea here is to get with price action. All right, let's take a look at a real example in the live market. Okay, let's give an example of a real trade here. I'm using this strategy, this 3 moving average strategy. We're using the 5, the 8, and the 13 scalping strategy. I'm going to need a very active type of a market to do this in. Right now, I'm trading E-mini NASDAQ futures, 5-minute chart during power hour right before the close. So what do we have here? We've got our 13, that's our anchor moving average. We've got our medium is our 8, and we've also got our fast as our 5. We need the break right here. We need price to break down and close beneath our moving averages, and then we're looking for that 5, our trigger moving average, to cross over our intermediate term or our medium moving average. So right there, there's your crossover. It's time to go ahead and sell this thing. Okay, we're officially short the market. We're watching to see exactly how this thing develops. Now, how do we manage it? Remember, every trade has 3 parts. You've got your entry, you've got your profit, your stop loss. For me, the stop loss is best advised as being above that previous swing high. We can go right there with our stop loss. Now, our profit target, we can either attack market structure right here, maybe this swing low. We could even aim it down for this order block here, or we could use a fixed risk versus reward ratio. Now, if we cursor over to our trading DOM, you'll notice we've got a pretty good trade going right here. We're sort of in the green. We've got an opportunity potentially to get into this market for a pretty darn good trade. So what we're looking to do is we're looking to stick with this thing as long as we have a reason to be in the market, we stay in it. So right now we have a reason to be short, and pretty much we're just in a waiting game now. So for me, I've got my stop loss up here at 24.28 or 20,428. We're starting to see the market fall away. We're down here at about 24.04. Our entry point is going to be right here on this bar close. So we're right there at about 14, and we're starting to really see the action come our way. We're in the green by about 12 pips. So I would say our profit target, let's go ahead and shoot for market structure down
down there, which in this case is going to be a pretty good opportunity of about, 40 points, which with E-mini NASDAQ's about 160 ticks. So let's just go ahead and see how this one pans out. All right, bang. That's exactly how you make the trade. That's exactly how you execute. Now, remember, there's a couple of things that you're going to need to do to be able to succeed with this strategy. Number one, you've got to remember price needs to be beneath all three moving averages, and it absolutely was. This is a 5-minute chart on an active market, and look at what we had right there. There was our crossover, and we nailed it. Bang, we got short. Now, my stop loss was above that previous swing high. Not too bad. My entry point is right here. What about my profit target? Now, there are no rules with your profit target. You can let these things run until you get that 9 to cross, or excuse me, the short-term 5 to cross back up over the 8. You can stay in the market that long. You could put a fixed risk versus reward on here, or you could just base your decision on market structure like we did. We were shooting for this order block down here somewhere around 20,388, and we got it. So the most important things to remember here: number one, dial in your risk. Number two, understand that price has to be beneath all three moving averages. And then you're waiting for your trigger. Your short-term EMA crosses over the center. You're in the market. Your profit target, you can either do it like we did based on market structure. You could put a static risk versus reward on it, or you could just go for the ride and see just how far this downtrend goes. The most important aspect of trading this thing successfully is picking a market that's going to move when it's going to move and picking the correct time frame. We have a live market here, E-mini NASDAQ futures 5-minute chart, a lot of volatility, a lot of action. That gave this thing a chance to work, especially during power hour. But on a 4X, maybe a 4-hour chart, something like that could work very well to use this maybe in a swing trading type of a capacity. So that's a conventional way to execute the three moving average strategy. We got short and we made a little bit of money on the play.
The biggest criticism of all moving average strategies is that they tend to get chopped up. However, you don't have to fall victim to chop. Trade active markets and active times and implement the triple moving average strategy. Now, if you need help doing this, check out a live stream at How to Trade. Come on in and ask some questions. The coaches are going to be happy to help. Now, this video only covered the conventional triple moving average strategy. It may also be used to trade reversals and continuations. Now, if you want to see those videos on those strategies, leave a comment below. All right, that's it for now. Like, subscribe, and we'll see you on the next one.